Markets are through the hardest part of November where historically we see some kind of trouble. NVIDIA earnings did not sink the ship and Bitcoin continues to flirt with the big bad 100K mark. There's a ton of orders there to sell though, so not unreasonable if it cools off. Generally, until proven otherwise, the bulls remain on parade, even in the face of a massively disconnected bond and interest rate market, which we'll get into. So welcome back to the Trade Brigade Weekend Show, where we'll take a look through all of the data points and build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got one additional trade idea to share with you that you won't want to miss. With that said, let's jump right into the charts. So kicking things off on the SPY weekly time frame, talking about candle structure and location as we always do. In terms of structure last week, we've got a solid green-bodied bar, definitely smaller in size versus the election bar, but nonetheless it's still bullish. We've got a really strong close at the tippity top of the weekly range here. There's a little bit of a lower wick, which if anything would just imply that buyers stepped up off the bottom end of the weekly range. If we're thinking about location, we've absolutely got an inside bar with a higher low, but yet a lower high on the bar-to-bar count. So location might strike you as being neutral on the bar-to-bar, but generally speaking, the hold of this level right here is just oh so beautiful on the weekly time frame. This is a beautiful retest of the previous all-time high and the breakout level. So for all intents and purposes, the major trend is lows, soft higher lows, firm higher lows, and this could easily just become the next soft higher low. The reason I say soft still is because this technically did not flip into a major daily downtrend. We did hold up for a daily higher low as well. If we bring in some of the additional indications here coming in from the bottom of this move up to the all-time high, all of this is taking place well above a 38.2 Fibonacci. If we throw on the weekly anchored view apps, completely above all of those, and we can even check in on the good old volume profile here on the weekly, and just make note that of course, as we're headed back up towards the highs, we did end up closing over the high volume node. We actually use this as support, so all set from this perspective. I do want to clear this up, and I do want to zoom in with the Fibonacci's one more time from the low of this bar up to the top, and just also point out that even from a more nuanced perspective here, we're also above the Fibonacci 38.2, classifying this as a miniature bull flag. You could probably, consider that a daily bull flag as well. Speaking of the daily time frame chart, let's head on down and take a look at the weekly expected move, which is this box right here. If you're not familiar with this study, check out the video tutorial in the top right-hand corner. If we're contained by the upper bound, the number's at 602.21, implying a brand new all-time high and a higher high in the trend count. If we're contained by the lower bound, the number's 588.68, implying a higher low in the trend count. And it's not ideal. It would be best if the market actually held up over the top end of the 4-day balance range from back here. That level and the line in the sand that I would start using for a daily higher low is actually here at 590.25. So I'm going to be carrying forward that level. But if we're thinking about the overall trend and the trend count on the daily time frame chart, we've absolutely held up here for a beautiful higher low. This is the exact thing that we were just looking at on the weekly time frame chart, where we held up for support over the previous all-time high. The 4-day balance range has resolved in the upward direction, and most interestingly, on the Thursday session, we ended up opening on a massive gap up. This is on the heels of NVIDIA's earnings. Now, NVIDIA did not have the best morning on Thursday, if you recall, and notice that the market actually looked back underneath the 590.25 level, the top end of the multi-day range. So in the classic sense, you would be thinking that, okay, we're sort of producing a look above and fail. It's not unreasonable for consolidation to happen back in here, and suddenly the danger becomes what? A daily lower high from here to here if we had closed Thursday's bar underneath 590.25. But as we're looking at the chart in front of us, was that actually the case into Thursday's close? The answer is absolutely not. We ended up seeing a pretty strong reversal dead off the lows of day, straight back to the opening print for a strong close over the opening print and a massive recovery effort. We followed that up on Friday, technically making a new bar-to-bar higher high and also offering a massive higher low. The next major step here on the daily time frame chart could either look sort of two different paths or what I'm considering. You could get upside consolidation back inside of this overhead range, another 4-day balance range from back over here. Or if the market does want to pull back, it's okay if the daily time frame chart spots a higher low over the top end of the range that we were just describing at 590.25. If we just put ourselves in the shoes of sellers, right, this is the most powerful thing you can do in the market. Ideally, on Thursday, sellers wanted to close in the balance range and then to potentially continue to close the election gap down below. Did that take place? Obviously, we've already answered this question. The answer is absolutely not. And for now, it seems like bulls are on parade holding this daily higher low in the trend count. And we also know if we come in here with the daily 20 SMA, this was a nice little hold of the daily 20 as well. So generally speaking, one more time on this time frame chart, we are looking for consolidation here and breakouts to blue sky territories. If we pull back, it's all about the hold of 590.25. If we take it on down to the hourly time frame chart, let's get even more granular and evaluate this move from this perspective. Here it is on Thursday. You open and it's a straight up opening drive underneath the top end of the multi-day range. So we can just continue to dissect this move. It's a pretty strong looking sell side bar in the first hourly candle. Was there any response off the top end of the range? The answer is absolutely not on the first test. So you would think that the sellers had momentum, they had edge there. And what would have happened intraday if the sellers were going to continue? Well, some kind of lower high underneath that level to keep the market inside of this balance range. Again, it simply did not take place, and we can just see how strong the response was from the buyers, getting strong consolidation into the afternoon, even over the opening print of that Thursday session, right? Although we ended up closing pretty close to the opening print, a majority of the consolidation, the open, then started to act as support. So we're still not seeing any semblance of stronger sellers getting active in this market. It's bulls on parade, as we've continuously been saying here. The weekly trend is up, the daily trend is up, the hourly trend is now back to up. You could think of this as some sloppy sort of double bottom like so, and as long as we're over that neckline, it's the same thesis that we just put forth on the daily staying over 590.25. In a picture perfect world, this consolidation just persists right here, and we get a Brigade bolt over Friday's highs over this 595.25 level, which sort of acted like the neckline of the double top from back over here. If we do get this higher low, that's where I would start looking for those upside rotations into the all-time high. Since we're just a hop, skip, and a jump away from it, it's also a good time to point out and remind folks that technically speaking, there's an overnight all-time high that was made here at 601.02 is the exact level. And what we know about overnight all-time highs is that that typically does not represent the end of the auction to set some sort of extreme in the market. So I'm not saying we have to go there in the blink of an eye on Monday and take that level out to repair it, but it is something to carry forward in the narrative. If we are going to see a stronger reversal to the downside from the sellers, I think it's quite clear what needs to take place. You would need to see a pullback to here, an hourly lower high set, and then some sort of breakdown back into range. The alternative that would be even more bearish would just be that it's an opening drive that does not stop at 590.25, sets a lower high underneath, and then gets that rotation to the downside. This is what the bears want to see, and notice that this is technically starting to extend the market underneath the lower bound of the weekly expected move. It is a shortened holiday week, of course, with the US Thanksgiving holiday on Thursday, so keep in mind markets will likely be sluggish and maybe slow ever since or starting on the Wednesday afternoon session as folks start to take some time out of the office. What that does typically mean is that volume will decrease, liquidity will dry up a little bit, and sometimes, although it may seem counterintuitive, that may mean wider moves, more volatile moves in the market with fewer participants actually providing liquidity to the market. So it's just something to keep in mind there. Generally speaking, the pathing still stands, so I'll draw that one more time. Either a pullback into this level that supports is great, and we'll look for upside continuation. Consolidation here that Brigade bolts over 595.25 is great, looking for the all-time high. If this does reverse, and let's just use a dotted white line here, and then comes back down for an equal low, that would be a look above and fail on the balance range. And the most bearish thing that could happen here, of course, is this here. I suppose we should also bring in a bullish opportunity, which would be a straight up rally, and something ideally sets a higher low over 590.25. I'm not going to go all the way down there and meddle with this drawing, but you get the idea. Something along these lines should likely come up and repair that overnight all-time high that we were just describing. So that's the general pathing. And once again, remember, it's a shortened holiday week, so please just manage expectations from that perspective. We can quickly come in here with a Fibonacci from the top end, the previous all-time high, down to here, the low end of the balance range. And we're just pointing out from this view that we are technically consolidating over the 61.8, which is more of a bullish indication, which would improve the odds of a 100% retracement, right? The more times you close, in this case, hourly bars over the 61.8, the greater the likelihood that you do see the 100% retracement. For bears, you'd have to get back down underneath the 38.2, which lo and behold is beautiful confluence with that 590.25. If we take that off and quickly throw on the intraday anchored VWAPs, what can we see from this perspective? These will start to play catch up. Let's auto zoom this out a little bit so we can see where they're anchored from. This is the gap down. This is Microsoft earnings, if you can remember all the way back to then. This is the election gap up. This, of course, is the gap down from Friday of 2 weeks ago, and this is the all-time high. So generally speaking, 590.25 will have confluence as the week and time continues to pass along, and this also will provide some slight confluence at 593.50. That's the level, in case it's very difficult to see on your screen. That's that upper consolidation that we were just describing that Brigade bolts over 595.25. The general takeaway here is that we're above the entire cluster of the anchored VWAPs, which of course is more bullish than it is bearish. Let's continue along to the market internals. If you're not familiar with this dashboard, check out the video tutorial in the top right-hand corner. Generally speaking, let's ask and answer the question, do we have more bullish activity at the exchange level or bearish activity at the exchange level? Volume flows on the week are definitely substantial, up and over 500 million. We close out the week at 795 million, almost 800 there, with substantial reads on the two breakout days, which I would classify as Thursday, the gap up, and Friday, that bullish consolidation at the highs. Notice over 300 million and right at 300 million into the close on the volume flows for those days. If you look at the advanced decline line on the Thursday and Friday session, definitely close to trend higher zone, but not squarely in it on the Friday session. The intraday index score is a little bit mixed on Thursday. The recovery effort does bring it back up towards the zero mark, which is a good sign. If this had stagnated late into the day as the market was recovering down towards the lows, that would be too much of a divergence for me to really feel comfortable about, but the fact that it's back to zero is a decent indication there. Friday, not the strongest read, but we did ultimately just get a day of consolidation and balance. The fact that it's positive does strike me as being more bullish than bearish. Cumulative tick strong here. Generally speaking, at the exchange level, we are seeing the market participate in the upward direction more broadly, and we'll see this based on breadth as well once we get on over to the breadth indications towards the end of the analysis. If we're looking at the market profile, again, if you're not familiar with this dashboard, check out the video tutorial in the top right-hand corner. What do we see with value and the point of control as the Thursday and Friday session took place, right? Well, Thursday, value is absolutely higher. Point of control is right up towards the close. Friday, mostly higher inside the individual range. And look at that big old fat poor high. 1, 2, 3, 4, 5 TPOs straight across the top. That is the improper end of the auction. And in theory, if tested, we should be expecting a breakout through the Friday high to get continuation in the upward direction. The big tell there, if this is going to turn into trapped overhead supply, is that you would test and break through it and then fail quickly back down inside of the Friday range. If something like that takes place, that really sets up the situation where you possibly have, if we just flip back on over to the hourly chart, you possibly get something that looks like this, right? You come back into Friday's range. I'd be thinking about the pullback down to 590.25, then waiting for a potential daily higher low to form off the top end of the balance range from back here. Pretty congruent with the analysis we conducted on the daily and even hourly charts here, so all set from that perspective. If it repairs and stays above Friday's high, I think it's just rock and roll into the all-time high and potential repair of the overnight all-time high as well, like we were just describing. Let's jump on over to the nasty NASDAQ and see what's going on from the QQQ weekly perspective here. Let's take ourselves a little look. Let's fire up a clean chart and see what's going on from a candle structure and location perspective. So, in terms of candle structure, solid green-bodied bar, very, very minimal upper and lower wick, smaller in terms of range relative to the election bar, of course, very similar to the S&P 500. And one of the things that I want to point out here in terms of location, yes, it's an inside bar, but it's definitely lower, right? You can see it's about 50% of a retracement from the red bar in the week preceding, and we've just barely closed back at slightly over, actually, apologies, the previous all-time high. I do like the fact that this is holding in here and we have not come in for another test of the weekly double bottom neckline from this perspective back here. Another test to this level, it's a little bit hairy. That would definitely not feel good on the weekly time frame chart. I would imagine that we fall much more into a weekly stagnation, which we would like to avoid if we're looking for an end-of-year rally, a Santa Claus rally, to sort of flesh out 2024. Let's come in with the Fibonacci's from the bottom of the August 5th panic up to the all-time all-time high, all of it well above the 38.2 on the topic or subject of Fibonacci's from the bottom to the top of the election bar back over the 38.2, another bullish indication from that perspective. Let's come in here with the weekly anchored view apps on the NASDAQ, and these are supportive over the neckline still of the major double bottom from in the past. So again, although it's not comfortable, technically if we're above this, we're doing okay from the major weekly trend perspective, noting that we would just say we have lows, higher lows, soft higher lows, firm higher lows, equal lows could persist if we're getting confluence of support, Fibonacci 38.2, neckline retest, anchored view apps. Equal lows kind of keep the trend in consolidation instead of flipping firmly back to down. If we quickly check in on the volume profile on the weekly time frame chart, let's see what we can see. Did we close over the high volume node? The answer is yes. We are back above the high volume node, which is more bullish than, of course, it is bearish. Let's drop it on down to the daily time frame chart, get into the weekly expected move for the NASDAQ. Thinkorswim can keep up with our clicks here. The expected move is this box right here. If we're contained by the upper bound, the number is at 513.82, implying kind of an equal high to what we have back here at the all-time high, slightly underneath if you want to split hairs. And the low is also right on par with the lows of the multi-day balance range from over here. That's at 497.75. It's sort of tucked in there with that level we've got. So not as bullish on the weekly expected move out of the NASDAQ. And another big glaring difference here on the NASDAQ's daily time frame chart is that we did not close this gap from in the past. I know we didn't really spend much time talking about it on the S&P 500 because it maybe seemed a little bit obvious, but this gap had closed, and we closed back over that on the Thursday session. If I quickly go back to the QQQ NASDAQ, what you'll notice here is that the gap did not close all the way, and it still potentially offers the threat of a daily lower high, right? If we get a gap fill reversal up against 508.25 that comes back down and cannot support at 503.25, starts to look a little bit more concerning, right? You've got high potential for a lower high here. Any sort of equal low back down at this easily closes the remainder of the election gap, gets back down into the daily 50 SMA, and at that point, I would say that you're falling into a daily stagnation. Generally speaking, this is kind of like a long-standing daily balance. You set some lows back here, lows. You could even subdivide this and say that you have another daily balance that looks like this inside of that range, but generally speaking, back down underneath 503.25, if a daily lower high is established here, to me, really starts to set the stage for a little bit more stagnation into the end of the year instead of a continued rally to highs and potentially making new all-time highs. Something else to point out from this perspective as we maybe zoom out just a little bit is that you could start to imagine. Now, I don't want to be overly aggressive. I'm not trying to paint the picture prematurely, but you could imagine if this does yield a lower high, what does that suggest from a pattern perspective? Left, head, right shoulder. Now, all of a sudden, you have some sort of neckline that could be drawn in like this. Under the neckline, again, not calling for an Armageddon crash, and this is still a stretch of the imagination right now. We don't have the lower high confirmed, but just sort of pointing out what we might want to be thinking about if we do start to see failures of what are the key levels, probably 503.25. You'll notice on the Friday session that we did hold that as the low of day, basically right here in the lower wick of Friday's bar. So if we're above 503.25, I would still maintain more of the bullish stance, looking for the gap to close, and in a picture-perfect world, getting continuation through that level at 508.25, Brigade bolt higher low above, and looking for continuation to the upside. This is the optimistic take for the technology side of the market, of course the NASDAQ being reflective of that. The reason, and we'll see this when we get to the sectors, the S&P 500 is so much stronger is really because of the performance that we got last week out of the XLF continuing to push up towards new all-time highs, actually making new all-time highs on the Friday session with the breakout. So generally speaking, with a lack of representation from financials in the NASDAQ, this is one of the concerns I have, right? You get some sort of gap close. If this fails and we're underneath that key level we've just described at 503.25, now all of a sudden the sellers probably have an edge, not only from a daily lower high perspective, but also a look above and fail perspective, easily making the move back down towards 497.50, lower edge of the weekly expected move, 497.75. And this is a very mechanical and weak level, right? Notice that we have 1, 2, 3, 4 very precise touches to 497.50. I would not want to be a new money buyer on the 5th attempt after a failed breakout and a daily lower high is set. So if we do make it down here, I think this is where the market starts to really exhibit more concern for the technology side of things. So once again, 503.25 sort of becomes an important arbiter of price from that perspective. You got to stay above, you got to see continuation to the upside, and ideally some sort of higher low found over 508.25. Let's take it on down to the hourly time frame chart, and we can see what's going on from this point of view. Very similar to the S&P 500, where I would say okay, let's just think about this for a second. Do we have stronger sellers or stronger buyers? Well, on Thursday's gap up, buyers did not step up at the top of the range for the first retest. It had to go all the way to the bottom end of the range. And this is actually a good thing, right? Typically, when you have a wall-to-wall move, it becomes easier to buy that support thinking that, okay, sellers are probably exhausted coming into this. So great little trade there on Thursday. But generally speaking, did the sellers ultimately manifest a lower high underneath that 503.25? And I realize when I say manifest, it's like, oh, let's think really hard. Let's envision it. Can we get the lower high? It's not really what I mean. Just did the sellers have what it took to put in a lower high here? The answer is no. And just like the S&P 500, you get the consolidation over the key level, the top end of the balance range here. The only difference, and again, we've continued to point this out with the remainder of this overhead gap, the S&P consolidated over the opening print on Thursday into the afternoon. Obviously, the NASDAQ did not. So you've got a two-day high breakout point. Technically, this is an inside bar, inside hammer on Friday. And I think the trade setups here are very self-explanatory. In here, not interested. Definitely interested in potential breakout trades over 506.25 to close the gap. Have to be mindful for a potential reversal off of that. If you can hold up over the two-day high for a higher low here and retest, I would tend to think this is the trade we want to entertain there, with just generally speaking, more of a bullish sentiment in the market right now compared to a bearish one that's over 508.25. Starts to rotate back up towards the all-time high. Please be mindful of this level, which is at 512. Remember how many times we saw the look below and fail, look below and fail, look below and fail. Finally, on the Thursday, that's when Jerome Powell was speaking 2 weeks ago. That was the nail in the coffin. But I'm still very interested in 512 to gauge whether or not there's a reaction there. So those are your key levels to the upside. All-time high sitting at 514.85. The overnight all-time high at 516.69. So carry that forward as well. If this ends up turning into a reversal and we find ourselves back here, starting to look a little bit more dicey for a potential one of these, look above and fail. And as we know, and as we've spoke about on the daily, the target is clearly down at 497.50, the bottom end of the 3-day balance range from Monday, Tuesday, Wednesday. And of course, the remainder of the election gap becomes the target down at 494.50. The gap closes at 492.50 with our daily 50 SMA meeting us there for confluence. Let's check in on the Fibonacci's from the all-time high to the pullback low. We are not over the 61.8, unlike the S&P 500. The 38.2 is, though, confluence with 503.25, reinforcing that level there. If we throw on the intraday anchored VWAPs, what else can we learn? We are not over the entire cluster, but we are over the Microsoft gap down, and even the gap down from the Friday session of 2 weeks ago. We're over those two anchored VWAPs. It's really a matter of closing this gap, staying above the band, and trying to fight for price acceptance over 508.25. My primary ideas here is that we do want to lean a little bit more long as opposed to short, but more so open-minded to shorts on the NASDAQ versus the S&P 500. And this has been the same old rinse and repeat take on the NASDAQ versus the S&P for a number of weeks now. If we check in on the nasty NASDAQ internals and see what's going on from this perspective, we do still have a strong display of buy-side pressure into Friday and even Thursday, getting close to trend higher zone, generally speaking, on the week. Much more volume inflows compared to volume outflows. In trend higher zone over here on Friday, close to it on Thursday. And even the days like Tuesday in particular when we gapped down, the advanced decline line was unable to close under the zero line. We talked about that on Wednesday during the midweek market update. Thursday and Friday, decent bullish cumulative builds on the tick, all set from that perspective. At the exchange level, again, probably leaning more bullish than we are bearish. If we move on over to the NQ market profile and see what's going on from this perspective, I think what we'll just notice is the equal high sort of nature from what's happening over here. There's a decent excess high in this A period from the Thursday session, and value area high is here. So this is a little bit mechanical, just shy of 20,900. If we break out over that, we know that there's a level we've been paying attention to at 21,081. That is your NQ target to the upside if we can get the breach of this 20,900 roughly. Notice that the point of control on Thursday with that big look into the range and then closing back up above, right? The point of control is higher. On Friday, the point of control is sort of in the midpoint, but pretty much unchanged from what we have from Thursday, just meaning that if this was going to turn into overhead supply as this pulled back, you would have expected the point of control to migrate lower on Friday. It just simply did not. Once again, a slightly more bullish than bearish take here on the market profile. Let's get back on over to the platform and take a final look at our third index here. And what we want to do is look at the IWM on a weekly time frame chart for our small caps, and a beautiful, beautiful looking chart. This is one of the cleanest charts that we'll see here in quite a while, I think. But look at the weekly. I mean, before we even talk about candle structure and location, beautiful ascending triangle, Brigade bolt right over the top of it. The daily chart was very playable with an inverted head and shoulders right off of the retest level. Very, very clean chart. Strong follow through on Thursday and Friday, right back up towards the highs. So awesome looking chart here, obviously leaning much more bullish than it is bearish if we're thinking about candle structure and location. You've got a solid bodied green bar with a little bit of a lower wick. Once again, if anything, that implies buyers stepped up near the lows and we're able to close smack on the highs of the weekly range here. Generally speaking, we did make on the bar to bar count a lower low and a lower high, which at first glance, it's like, oh, okay, I guess that's a little bit bearish. No, it's not. You looked underneath a solid red-bodied bar's low. Did the sellers find follow-through in the downward direction underneath what was a very important weekly area of support? The answer is absolutely not. So sellers got, steamrolled here basically, and buyers prevail, closing right back up at the top of basically this pivot high on the weekly. So definitely in the bull camp here on small caps. If we come in with a Fibonacci from a number of perspectives, come in from the bottom of, I had been considering this ultimately a weekly or even monthly balance range for a while. We've broken out of that, of course, and this is all happening over the Fibonacci 38.2 if we measure from the most recent high. That, of course, is bullish. If we come in from the low up to the high, obviously we've closed over the 38.2, and the deepest the pullback went was to the 61.8, another bullish indication from that perspective. If we quickly check in on the anchored view apps, completely above them, and hopefully over time we get better confluence at the top end of the range, just meaning that if we do pull back for another round trip all the way to the top of the retest level, which would not be ideal, and there's no indication of that currently. Wouldn't be ideal, but technically speaking, as long as that support holds, we would be good to go. So again, watching for these anchored view apps to play catch up over the span of the next couple of weeks or even months to end out 2024. If we check in on the volume profile, this will be interesting because as we know, I'm going to grab some more time here. There's actually, we have not made new all-time highs yet in the rusty rut, but we continue to use this, right? The huge high volume spike from all of this congestion back in 2021. We're using that as support, right? That's kind of where the low of last week was found. It was a structural area. It was a volume-related area. This makes sense to me and continues to look much more bullish than it does bearish. Let's take it on down to the daily time frame chart and see what's going on from a measured move perspective, or expected move, I should say, from the market, the options market. What do we see here? So the expected move is 243.48 on the top side and 234.08 on the downside, implying a higher high, not yet a new all-time high, but pretty close. It's a dim level here, but the all-time high, let's actually just beef it up and make it gray. There we go. Is at 244.46. So just, within spitting distance, if you will, of that all-time high at the top end, implying a higher high that's bullish. And this, of course, implies a big-time higher low at 234.08. So all set from that point of view. There's really been some sloppy-ish structure through this area. I actually think this level should not be dashed. It probably deserves to be something like this. That's at 236. That would be the ideal higher low if this wants to put in some sort of consolidation, stay above that, then get continuation in the upward direction. As we were saying on the weekly time frame chart, as we came in for this really important retest of 227, I think the biggest takeaway on small caps is that we actually gapped down on the Tuesday morning session. There was no follow through, and we actually closed near the highs of Monday's inside inverted hammer relative to the Friday session of what is now 2 weeks ago. So that is the first indication here where, okay, this sell-off is a little bit exhausted, right? This is a classic sell-side exhaustion gap down. And then on the intraday, if we just take this down to the hourly now, actually, you can see what built out here. This, we probably should put this in a textbook that's coming to a bookstore near you, maybe in 2026 when you get that published. But anyways, look at that inverted head and shoulders. Look at the thin structure retracement, right? Straight back in the upward direction. Beautiful reversal, very playable here. It was clear as day. And now, once again, if you look left, if we can stay over this structure from the past, that of course would offer the opportunity for a clean higher low. That's 236 once again. You get a little bit of the flat high of day rejection area there at 235.50 from the Thursday session. Any hold over this zone looks really good for the next higher low in not only the hourly sequence, but just the daily sequence to basically make it back up towards this high and hopefully back up towards the all-time high. What we know about the small cap sector right now, or just market, is that M&A activity is slated to pick up as we move not only into 2025 with, all of these deregulations that are being proposed, but also as the Fed cuts rates. Like, I've got a chart to show you this in just a moment as well, but like, don't forget, as the, financial or monetary policy from the Fed eases, technically that makes it easier here for M&A to take place, and there's a lot of small banks, there's a lot of boutique stuff here in the IWM that would be of net benefit from ideas and sort of conditions like that. So generally more bullish than bearish here, and once again, this is a supportive tailwind mostly for the S&P 500. If we bring out the Fibonacci's from the top of the move to the pullback low, what do we see? Are we over the 61.8? Absolutely. And is that confluence with a key level? Absolutely. 236 is that key area. The 38.2 is technically confluence with this low back here, 232, 25, 75, give or take, give it a little bit of a zone, right? But it's thin structure on the way up. I'd say your big areas here on the intraday will simply be 236 and then all the way down to the neckline. If we set an arbitrary, it's not really arbitrary. You know, maybe you've got a little bit of something happening there. But if you set the higher low here, still counts, still looks awesome. Looking for daily continuation of the trend in the upward direction. Last check on the intraday is our anchored VWAPs. We're above the entire cluster, and this is slowly starting to provide confluence at the better level, which is 236. So can't say enough bullish things about small caps. It doesn't mean that there aren't going to be pullbacks. Let's be very clear about that. Markets do not move in straight lines forever. So there can be pullbacks, there can be consolidation, but generally speaking, what this is suggesting for the broad market is bulls on parade. Is it being supported at the exchange level from the index perspective, Russell internals? Absolutely. Look at the follow through on Friday, strong volume flows. It's been very rare that we've seen the Russell actually make it to its threshold here, so impressed with Friday's volume. If we look at the advanced decline line, near trend higher zone into the end of the week. If we look at the cumulative builds out of the tick, definitely more bullish than they are bearish. All set, checking 3 of the 3 bullish boxes on the internals. Final check here for our Russell instrument is going to be the market profile for the futures. And what do we see? As prices breaking out, value area and point of control migrates higher, value area and point of control migrates higher. So it is validating these higher prices. Markets are basically validating that these are fair prices. So in all, it does mean that the cost basis is being raised here. And if there is going to be some sort of pullback, it is easier to topple over some of these structures versus a more normal looking distribution like this. But that's fine. I think that we've understood basically from the hourly time frame chart that pullbacks are okay here in the Rusty Russell as long as we find a higher low. One of the reasons why I would lean into the Thursday flat top rejection area and support that we were just talking about, 236 on the IWM, is because that keeps us above at least this value area from here. You might get some shakeout from longs late to the party from Friday, but if you're over that Thursday high of day, I think you're rocking and rolling for that higher low that we were just describing. Let's get back on over to the platform here and talk about our sectors in the S&P 500. We'll continue to dig deep and see what's going on in the marketplace here. What do we see in terms of weekly performance? Top of the pack is real estate, up 3.04% on the week, followed by materials and utilities. Okay, let's pause here. Little bit of a white flag. Why is that the case? Well, real estate technically as a hard asset could be seen as slightly defensive. I'd call it more interest rate sensitive, and interest rates honestly remained elevated this week, so that's a little bit of a head scratcher. All right. Materials, really lightweight sector. Doesn't really have much to do with defensive versus aggressive risk on. I'd say maybe it sides more so with the cyclical side of the economy. It makes sense. Again, interest rate sensitive. Utilities, also interest rate sensitive, but ding, ding, ding. This is where we have to start thinking about D for defensive, right? So is a defensive sector or is defensive posture really pushing this market higher as we've broken out of the 4-day balance range? The answer is yes. It's not enough for me to say like, oh my goodness, okay, throw your hands up in the air and short this thing into the ground. But it's enough to start thinking about if the market continues to be fueled by these sectors and it's attempting to make new highs, you might not want to be a breakout trader around these areas. If the market does make it up towards all-time highs in the S&P 500 in particular, this upcoming week, what I would need to see take place is leadership from the semiconductors as well as the tech sector. We'll take a look at both of those charts in just a moment. Now, as I've put forth this idea that maybe defensive sectors are leading a little bit more so than what we'd like to see, another question to just bring us back down to reality and ask is like, okay, well, were the risk on sectors dramatically underperforming? Were they red? And the answer is no. I mean, semiconductors still up over 2%. Same thing here with the technology sector. Financials, a little bit more of a laggard relative to that 2% figure, but they're still up 1.64%. So it's not that we're seeing underperformance from those sectors. And as a matter of fact, their charts probably look better. At the bottom end of the barrel, the true laggards are the TLT bonds there. And then we have discretionary and communications. Let's check in on the structure and see what's happening. So real estate, we know that we're mostly concerned when a new swing low or swing high is produced. Do we have that? No. In the midpoint of a range, so there's not much to say here. It's bullish until proven otherwise. XLB Materials, strong higher low hold at the daily 200 SMA for a weekly higher low at this point, not a daily. Daily is definitely in a downtrend with highs, lower highs, potential for a lower high, lows, lower lows, lower lows, but the weekly could still be considered up if you were to strike a trend line that looks maybe something like this, pretty much mirroring the daily 200 SMA. The hold of 91 is important. The other important thing here is the recapture of 93.60. Matt, why are you spending so much time on this? It's the lightest weight sector. That's a good question. Let's move along. Probably bullish pressure as long as it's over 93.60. Next up, utilities, D for defensive, poised to break out and move into blue sky territories. Sharp rejection on Friday, but it doesn't mean that a higher low can't persist. Another attempt, you can only knock on the door so many times before someone ultimately opens up. So watching out for utilities. If it does break out once again, it could potentially act as upward pressure for the S&P, but I would want to see even better and more promising strength from something like semiconductors and the tech sector. So let's work our way towards those. Industrials, looks great. Still in an uptrend, held a higher low, back up towards the all-time high. Bullish. Let's take a look at the SMH because once again, we've got a little bit of a concern here. I do like the fact that it's trying to hold up over the daily 200 SMA. We'll give credit where credit is due, but we also have to give the sellers some credit, right? Because technically, as of right now, still have the chance for a lower high, still have the chance to remain underneath this overhead supply. So 245, if we're underneath it, just building out bearish consolidation in my view, something like a bear flag happening here. It gets really ugly underneath 237. Underneath 237, I do think that we want to be skeptical and dial back some of the long and bullish bias that we've put forth so far in the S&P 500. A couple of things to read into if we want to, take a nuanced approach like we do on the S&P, NASDAQ, small caps chart. It's just that on Thursday, you opened on the gap up, you failed back into range, but then closed back outside of range. So as I'm thinking about even this, do we have stronger sellers? Doesn't seem like it as of right now. I'm still just going to be using that 245 and 237 level as the main judges of price action this week. In here, I guess we're holding on by a thread. If we can get this, great, really bullish for the S&P. If we get this, run for the hills, not looking so hot. Here's the XLK technology sector. A little bit better than the SMH with the continued and persistent higher low that's been built out on this move outside of the balance range here. But just like the QQQ NASDAQ, it still has the opportunity to reject this overhead supply for a lower high, building out maybe, again, this is not a direct call right now, some sort of head and shoulders. I get that the head maybe should have been a little bit taller, but you get the idea, right? So it's still on the table. I would only flip bearish when and if the XLK were to take out something like 228, 227, daily 50 SMA. If we take out the bottom end of the range, sure, again, throwing in the towel a little bit on being as bullish the S&P 500, but as of right now, a constructive first step back in the upward direction after setting a higher low, and ideally, next steps just look like this, and then a blue sky breakout that really helps build the bull thesis for the S&P 500. So as of right now, more bullish than bearish, and we're moving along to consumer staples. What do we see here? Breakout of the balance range. Nice little double bottom, perhaps, if you wanted to count that. Over the neckline with a strong close on the Friday session. So if we're over 8150, great. Technically, upside pressure is upside pressure. It's not breaking out to new all-time highs as a defensive sector. It's not leading the S&P 500. We're all set from that point of view. XLV, I love the little rebound off the lows here. This is sort of the magic recipe we were talking about in last Saturday's update video. After the RFK announcement back here, healthcare really took a tumble, right? And we sort of talked about how it was crucial. You held 140.80, got a counter trend move. If that could happen with the XLF also breaking out, that was the recipe for success in the S&P 500. That's exactly what we saw in the previous week's worth of trade. So going forward, I think it's worth acknowledging that, yeah, we're starting to get a little bit of an inverted hammer rejection after this counter trend move on the daily time frame chart. It's worth acknowledging you had a double top, kicked off a lower high. It's very possible that this could easily act as a lower high. I mean, even if it rallied up to the daily 200, this 148 level, that could act as a lower high as well. So we're not out of the woods here in the XLV, and Friday's structure doesn't really give me a warm and fuzzy feeling. I would really need to see the XLV cool off, go sideways, and not make an aggressive attempt underneath that 140.80 mark. So really continuing to watch this level, 140.80. As long as it can cool off and go sideways, it's up to the other heavyweight sectors, notably the XLK and the XLF, to continue to fuel the fire in the S&P 500. Underneath 140.80, I think you're really going to get an S&P that's stuck, even if the technology sector is breaking out, even if the financial sector tries to continue to extend its gain into new record highs. Let's move along to the energy sector. It's ripping to the upside. Crude oil is not, though. If you take a look at CL, Pretty interesting over here. I mean, a little bit of lift, but still generally speaking underneath this big inflection point around 72. So I think that generally speaking, this is all about the AI and data center trade, and making the note that, energy is top of mind for markets right now as this continues to come up in earnings calls, the sustainability of AI. There's a lot of talk about nuclear. I think that's going to be a big theme for 2025 reports, and we'll continue to keep tabs on it, but crude is not really reflective of that. So to me, this is sort of pricing in the AI trade more so than anything else, not just elevated prices in oil itself. If we move along to financials, what do we see over here? There's just that breakout we were talking about just a moment ago into new record highs. This is bullish for the S&P. Now gives it an opportunity for higher lows to persist over 50-10, then get continuation in the upward direction, lows, higher lows. I think the thing you mostly want to read into here is that we technically broke down on the Wednesday session, closing underneath 49.60, giving the sellers an opportunity to yield a lower high and push prices lower. Did it happen? The answer once again is no. So I know I maybe sound like a broken record in today's episode, last week's episode, a lot of episodes, honestly, but the key question to continue asking and continuing to answer is, do we have stronger sellers here? The answer repeatedly is just no. Sellers are not taking the opportunities to drive prices in the downward direction. Nobody wants to unload anything here. It still seems like people want exposure on the long side of the market. XLC Communications looks great in this consolidation, ideally breaking up and over the all-time high at 97.65 is awesome. Even if it pulls back weekly, higher low can persist off of a gap fill reversal, probably flips into a daily double top look though if that does take place. We'll monitor it as and if it does develop that way. XLY, Tesla strong day breaking out of the range on Friday, pushing this in the upward direction here. Still looks great. If anything, just a bull flag up here. Not much to read into. Out of this lower range into the upper, over 216 on consolidation is bullish for the market. Brigade bolts into blue sky territories. It would be concerning if you make a new lower low underneath 212.50, but Friday's price action wouldn't really suggest that that is top of mind. You tested it on Wednesday. Thursday, you tried to drive lower. Did the sellers make any headway? The answer continues to just be a big fat no. Let's take a look at the TLT. Bonds are sitting pretty weak, dead, kind of on these lows. Still seems to me that this can continue to break down here as rates are still threatening a move in the upward direction. So we'll talk more about rates in just a moment, but sticking on the topic of sectors, what do we see out of the ratio grid? If you're not familiar with this screen, check out the video tutorial on how to build it in the top right-hand corner. XLK continues to strike me as, not risk on or risk off, sort of more neutral. This is fine. This is a nothing burger. This looks absolutely phenomenal, as does this in discretionary. Generally speaking, 2.5, we'll say, with this acting as a 0.5 out of 4, probably leans slightly more risk on versus risk off. This is supporting that thesis. This is supporting this thesis as well. This is not in an uptrend. This is not in an uptrend. I think we're good to go from a risk on versus off mentality. We could see the same thing echoed in this chart, or display of charts over here. 1 to 3 year treasuries versus the tech sector, still in an uptrend, all set. We'll give that a bullish check. If we check in over here, this is utilities versus the tech sector. Not as good, but remember, we've sort of been trying to hold on to hope that maybe it just supports over the trend line. It is technically a pullback from here. In a picture-perfect world, it would have supported at this for the higher low. So let's say maybe neutral here, and again, give that sort of like a 0.5 in terms of its weighting. This is a number 1. This absolutely looks phenomenal. We don't even need to zoom in. That's another 1, and this also is going sideways up here. I'd probably argue that you could give this a 0.5 as well. This is healthcare versus the semiconductor sector. So generally, we're 3 out of 4 leaning in the bullish direction. Emerging markets still holding up over that 42 mark, which is all set there. There's a little bit of talk going around right now about the Japanese yen potentially loosely blowing up again. We're not there yet on the 6J. You can take a look at this chart here. This is the August 5th. Where is it? The August 5th panic is over here. I don't think this is adjusted actually for the contract roll, which is why this looks like it's exceeded that. We could go over to something like the USD JPY, and let's take a look on this spot yen. There we go, and let's flip this quickly to a candlestick chart. Thank you guys for bearing with me here. Let's go candles, and what you'll see is now maybe it did undercut it by just a hair. Oh, now it comes back to me now. We, of course, undercut it by a hair, but what did the actual Nikkei do, right? If you go to the N225 JP, There we go. This did not undercut its big low where there was big concern. The reason I bring this up is because there were some metrics that came out. I can't remember if it was late Thursday. Technically, it's going to be inverse to US times, right? But Thursday or Friday, Japanese CPIs came out and they were hotter than the expectation. And generally speaking, the Japanese central bank basically is poised to potentially raise rates, which is going to put pressure on the Nikkei as well as the relationship between the yen and the dollar. I don't think the yen carry trade 2.0 is going to explode in our face one more time. Hopefully I don't have to eat my words on that. But generally speaking, if we're looking at the Nikkei, it doesn't seem as though we're at a threatening point yet where, oh my goodness, everything's going to come collapsing down. I think you've already seen enough rotation because the general premise, right, that people were putting forth is that the yen carry trade really fueled the over leveraging in NVIDIA. I think we already saw the opportunity on sort of Thursday and Friday after NVIDIA earnings. There was plenty of opportunity to sell NVIDIA on the premise that, earnings are slowing down, the growth rates are slowing down. I don't think that this trade is going to, again, be a flash in the pan again like it was the first time. Remember that markets sort of have there's a zeitgeist to the market. There's always the new thing to be thinking about. And as of right now, it was NVIDIA earnings. That's in the rearview mirror. Right now, it seems to be Bitcoin. So let's move along from this particular conversation over to the dollar. Speaking of sort of interest rates, indexes, and what's going on here. So currencies, I should say, not indexes, but rather currencies. Dollar strengthening materially in the upward direction on Friday. This is kind of on the heels of some hotter than expected PMI reports, and we'll get into that in just a second. It's really the services side of inflation that continues to be an issue. So dollar moving higher. If we take a look at gold moving higher as well. Again, possibly coming back into view as an inflation 2.0 style threat or warning. We're not there yet. When and if, I should say, this outperforms this shelf right here, I'd start to be on alert. And if it makes a big new breakout high here, I'd say, okay, whoa, something's going on here with gold. We're not at that point. Speaking of inflation and sort of this more fundamental conversation, here is the 10-year interest rate. After the election, we sort of saw that move back into 4.3, but the consolidation has been holding over the breakout point, over 4.3. If we take a look at the weekly chart, right, there's a pretty clear path back up towards like 50, which is 5% on the 10-year yield, which is obviously going to, I would imagine, put some pressure on the PE ratios for the S&P 500. When it comes to economics, you're talking about probably seeing contraction when it comes to the cyclical side of the economy. Maybe the M&A activity we've been sort of talking about and touting as we're moving into 2025 doesn't materialize as firmly as we'd think. So really continuing to keep an eye on the interest rate market, the bond market relative to equities, because as we mentioned in the intro, there's just this massive disconnect right now between interest rates, the valuation of the S&P 500. Now, if you're an investor, what do we know about the SPX, right? If we just quickly go out to a multi-year view here, and this, of course, is going to be all skewed because of the way that the log scale needs to be applied. Generally speaking, the most painful moments in the market happen once a monthly downtrend is developed. Monthly downtrend painful, right? We've talked about this so many times on the channel. So the 10-year can be screaming at us all we want, but would I try to call a top in the S&P 500 when the chart currently looks like this? No, absolutely not. We need to flip into a monthly downtrend if this is going to materialize into a stronger threat to say, hey, start buttoning up positions in equities and dial things back into a more defensive posture. Inverted ZT continues to put the pressure on the Fed here to basically pause in December. So we'll see if that's the case. The current Fed tracker tool would suggest, if we take a look over here, that we've sort of balanced out the odds a little bit, getting closer to 50-50. It's a split decision. Remember that we will have another full labor report coming out, not this week, but the week following that. We'll get some labor data for November, and we'll also get a CPI report again prior to the Fed's meeting on the 18th of December. The odds will likely shift materially when those two announcements do come out, but as of right now, one thing that's a little sneakier is watching what's happening here at the bottom end of this chart, right? Basically, we had at least 3 cuts priced in. We had 1, 2, and 3 headed into, forecasting out to the end of 2025. You can see those odds have evaporated. And as of right now, it's 2 cuts remain. We have 1 into December. And then a lot of folks that I, highly regard their opinion, read some of their opinion pieces online and sort of view their track record. But they're saying that we're going to get a pause in December, and then, we're going to get one final 25 basis point cut in December, then a pause for, I don't know about the remainder of forever, but until the next big catalyst that would suggest the Fed needs to take action. So the neutral rate could sort of be around this area, in which case I think the market needs to revisit some of its earnings expectations and PE multiples, the multiple for the market itself. As we're looking at the calendar of economic events, you can see here from the Friday session, the hotter than expected services PMI at 57. There's your round two inflation sort of exacerbation, if you will. And that was really it in terms of major economic data last week. If you look at the initial jobless claims, really a nothing burger here, beating well underneath the expectations. So the labor market's not at risk of blowing up. There's really no rush to cut interest rates, especially noting that, what was it, 2 weeks ago now? Where was the CPI? It came in line with expectations. It's really stagnating. We sort of know on the core year over year, it's really found a floor at about 3%. So it makes sense to me that the Fed could easily cut 25 and pause, or pause and then cut 25. It seems to me that there's no urgency to continue to bring down rates, which sort of brings into question the rally we've seen in the S&P. But we'll just sort of continue to trade the charts in front of us with the understanding of this fundamental backdrop. As we look forward to next week, Monday, you've got nothing here. It's a clear calendar. Housing prices on Tuesday morning, consumer confidence Tuesday morning as well. GDP and unemployment claims get pushed up to Wednesday with the Thursday holiday. And the most disturbing part about all of this is that they're going to release core PCE at 10 o'clock. Usually this is an 8:30 pre-market announcement, but again, because of the holiday, that is getting pushed up. So 10 o'clock when the market is open, we will be getting PCE. Please be aware of that on Wednesday. That is far outside of the scope of normal things that take place. Understand that as we move towards Wednesday afternoon, trading volumes will likely slow down. We talked about this in the very beginning. Lower volumes often just means lower liquidity, which does not necessarily correlate to lower volatility. The less liquidity, actually the higher the volatility could be, with larger sort of distances between the depth of market basically on any instrument that you're trading. So please keep that in mind. Very likely that Wall Street's pretty quiet on Friday. Of course, Black Friday there after Thanksgiving, as everybody's sitting back, relaxing and saying, wow, can't believe I ate so much turkey last night. Let's take a look at some earnings indications here. What I really like about the earnings estimates is that they're starting to bottom out here instead of continue their descent. So that at least gives me some sort of hope that the S&P valuation is correct. If these can start trending higher, heck, that would be an even better look. As we look forward to the actual breakdown of the report, I know we just got NVIDIA earnings, but the main story here has been financials, right? And we talked about how the XLF is what's been pushing the S&P 500 higher, whereas the QQQ NASDAQ is actually lagging by a little bit. It's not enough to go out there and say, oh my goodness, short the NASDAQ 100, it's going to zero, but you are seeing supporting evidence of the actual earnings underneath the hood of the financial sector supporting that push in the upward direction. Another chart here, I was talking about M&A activity as the Fed starts cutting, as well as these deregulation talks from the new administration. Just look at what happened here between the Fed starting to hike and the Fed starting to cut, right? You can clearly see the, oops, we don't want to move the whole image, we want this. You can clearly see the decline. What you want to pay attention to is the green. Clear decline in mergers and acquisitions and completed transactions here, slowly starting to potentially uptick back up towards these areas. This was sort of like SPAC mania. If you remember, it seemed like every company was announcing not just an IPO, but sort of like a SPAC, and all these sort of different ways of getting public funding for the company. But that is slated to potentially pick up. And what does that mean for the financial sector? Once again, probably a more bullish than bearish take there for small caps and the financial sector. So S&P more of a long than the QQQ NASDAQ, which does not have exposure to financial institutions. If you take a look at the earnings calendar for this shortened holiday week, Zoom is possibly interesting. And I want to say a shout out here to Tom over at Walks in Wall Street, who I don't know if he's completely initiated coverage on ARK, but ARK, a lot of these laggards from 2021 are starting to catch up and break out of weekly bases. Zoom is definitely one of those in that category. We'll take a look at that chart in just a moment. Dell, some ancient tech here, is reporting, and then CrowdStrike is also interesting. That's a watch on Tuesday after the close. So let's get back on over to the platform here, and we'll take a look at Zoom and maybe CrowdStrike in just a moment, but I do want to continue with our risk appetite charts. Let's take a look at the TLT ratio to the S&P. No issues here. Risk on for equities down below. If we look at bonds relative to themselves, the shorter durations are still being favored, which once again, this is sort of indicative of that inflation wave 2 component we've been talking about. If we move on over to the credit spreads, You are getting a little bit of a counter trend move, but generally still in downtrend. So volatility should be doing what? Compressing. We'll see that confirmed on the VIX in just a moment. HYG in isolation, junk bonds, giving us a bullish divergence here as the market. We made note of this in real time on Wednesday. That was actually a really, really informative call there. So shout out to you if you've made it to this point in the video, number one. But number two, if you heeded that advice and this sort of look from the HYG chart, all set there, starting to balance out. I would just say that the next main watch is if we were to take this new high out, if we were to make new all-time highs in the S&P 500, I would at least want the HYG up and over this pivot high. It doesn't have to take this one out. It doesn't have to make a new high here, but it should make a new pivot high over this from in the past. Let's move along to the good old BTC and see what's going on with Bitcoin. Bitcoin, massive rally. I think the chart really speaks for itself. You guys know that we've been long this ever since it started to break the resistance trend line back over here. The risk reward is playing out. There's a massive wall of orders at the $100,000 per coin mark. As noted in the intro, Bitcoin futures technically hit the high. If you look at this box right here, $100,170 per coin on the BTC futures, but the spot price on the coin has not hit that yet. The Coinbase depth of market here sort of shows you the big call wall. It's not technically a call wall, actually. It's just a sell side. There's sell-side liquidity. There's a bunch of limit orders to sell Bitcoin at 100,000 at that area. So those are passive sellers. They're not aggressive sellers. If we sort of chew through that liquidity and I would say if Bitcoin chews up all that liquidity at the sell-side liquidity at 100,000, does not really back off aggressively, I think it's a pretty quick jump up to about $110,000 per coin here, which is more reflective of the cup and handle measured move that we'd been sort of talking about from the start. The cup really, it starts further off to the left, but there's the cup, here's the handle. Nice little breakout measured move is to there. So keep that top of mind for Bitcoin, and we will move along to our breadth here, because breadth, as noted with the, with the market internals, almost over the sickness, almost all the way over it. Breadth, as we noted with the market internals, looks really solid. Nice rebound still off the 50% mark out of the 50 SMA chart, which is the blue line. The green line has remained pretty stable and sideways, which is bullish, but notice new highs versus lows picking up as we've broken out of the 4-day balance range that we were just talking about on the S&P daily time frame chart. All set from that perspective, and another beautiful looking chart here is the RSP technically going on to produce a new all-time high. So the high of this bar back here was technically at 185.79. The high of this bar, 185.79. Do my eyes deceive me or what? Literally spot on the high. Maybe it's because the body of this bar closed a little bit stronger. We could say it's a new closing all-time high. How about that? But technically speaking, the intraday high was the exact same. I thought it was a new all-time high. Regardless, look at what's going on with the weighted S&P. It has not yet caught up. So to me, this is a bullish indication for the weighted index down below. Similar indication out of the QQQE, which is interesting because we've been tracking this for a while. It's been really on par with the weighted counterpart down below. But notice here, this is much more clearly equal highs, but notice what's happening with the weighted. It's got a little ways to go. So generally speaking, breadth would be a positive and bullish indication, even for the laggard NASDAQ that we've been talking about in today's episode. Dow Jones making a new equal high here. Transport's lagging slightly, but still just really thrilled with the breakout of this box down there. Generally speaking, bullish for the market. We saw credit spreads contracting, continuing their downtrend, so volatility moving to the downside is not a shock. Same thing here on the VVIX, yielding a lower high underneath what was support, now acting as resistance. Ideally, this happens and fuels the fire in the upward direction. As volatility contracts, usually markets move higher. If you look at volatility futures, we're going to have to update these not too soon yet, actually. But stronger contango, again, 9 versus 30 day is really strong pushback to the upside. After NVIDIA earnings were basically this solid green bar right here on Wednesday. Oh my goodness. Big sigh of relief, right? Back down underneath 1275. Once again, more bullish for basically money managers to allocate capital in the S&P 500 or other indices, index products, right? Let's jump on over to the core list of companies. I've done a little bit of a resort here. This is by updated market cap instead of Apple leading. Of course, NVIDIA is the top dog these days. Microsoft, then Apple, Amazon, Google, Meta, Tesla, JP Morgan, Netflix. And unfortunately, AMD has been demoted to the Encore list, and it is not the additional trade idea. So anyways, just the trade opportunities in AMD have been really, how should we say, not attractive. Let's just leave it at that. NVIDIA, what do we see? If you're going to trade semiconductors, NVIDIA is the name to trade. So after earnings, you sort of breached 150, could not close above. Obviously, we had talked about last week the big sort of call wall. Oh, it's gone now. But there was like 200,000 contracts at the 150 call wall set to expire worthless, meaning that stock was going to come up for sale if we closed below. Obviously, that sort of took place. You have an inside bar on Friday testing this low, but generally speaking, the big takeaway here is that you've failed to hold up over what could have been the higher low brick in the upward direction, right? You had lows, higher lows, higher lows. An ideal higher low would have been consolidation up here, and you even had the opportunity, barring some volatility from earnings on Thursday, you had the opportunity with the open above on Friday, simply didn't happen. So as of right now, this to me seems like it could easily turn into a daily consolidation range, which in turn would turn into what? Probably something like a weekly bull flag, right? Could you just get consolidation here, build out a flag, and then start to break in the future on, some positive news, some developments with Blackwell, perhaps. If I'm looking at the weekly chart, this is actually a good perspective to have. Pretty ugly looking weekly bar, look above and fail into blue sky territories, but a pretty weak close back down towards the open of the prior week's range. So weekly consolidation, daily consolidation seems very attractive right now in NVIDIA. Remember, markets have give and take. It's okay if this does consolidate and cool off. The one stock to rule them all will likely still do just as much volume, so it's the place to be if you're looking for highly liquid options that are tradable, decent price action as well. So it's still a top watch, but daily consolidation seems reasonable here. Ideally, it just holds up over this low at 137.25. Put in this consolidation here. I would really start to have some concerns if it's underneath this 132.25. I wouldn't want to see price in here, but I'd be okay with it. And then this is like, okay, nail in the coffin. Let's really start to reevaluate whether or not there's a weekly reversal, even in the downward direction. Microsoft, pretty lackluster price action, building out a multi-day range down here. Just like the broad market on the initial gap up. No semblance of support here, no semblance of support off of this level, actually a lower high in range. So one thing that I want you to pay attention to as we're going through the core list of companies, and you should inadvertently be doing this every single time we do this anyways, but think about what this means, because these are all basically QQQ components. Look at how these charts are developing, and suddenly does it make sense that the NASDAQ is lagging? Probably, right? So NVIDIA pulls back from the all-time high. Microsoft fails to break out, fails to hold over this, and is actually yielding a lower high inside of the range, whereas the S&P broke out. Thank you to financials. I mean, decent little rally back to the upside out of Microsoft on Friday, but you've got to prove it to me. You really got to prove it to me, buyers, with some kind of higher low that looks like this, breakout over 419.60, and then we're talking about an upside rotation. But generally, look at the daily chart. Anything impressive with the daily chart? Not even close to the all-time high, putting in a big balance range down here. It's pretty clear that tech is actually starting to stagnate just a little bit, and you've got a couple of big market leaders like NVIDIA, Amazon, maybe Meta just a little while ago. Tesla's helping these days as well, but outside of that, your Mag 7's not really performing as well as you might think, with the S&P just a spitting distance from the all-time high. Apple, another one where you could just say, hey, look at this balance range. There's really not much going on here. I mean, in the broad view of things, and maybe like the highest time frame perspective, sure, it's an ascending triangle. You've got massive higher lows that have continually built out, sure, but you're not breaking to new all-time highs yet. The market intraday has been really, really tepid to break out 229.50, so that level's honestly been demoted. We had a daily level here looking for the breakout to get to the top of the range. Now it's just, here's the balance range, this is the midpoint. Be my guest if you want to exchange in the range, but Apple's really not interesting here. Amazon, what do we see? No hold, no dice. We had an initial hold of $200.25, but currently pretty weak looking inside consolidation on Friday underneath that level really leads me to believe that it's very possible here on the hourly chart you have overhead range, overhead supply, lower highs persist here, and the gap close to the downside is really more so top of mind. So $200.25 is the big judge of price action if it does want to recapture that level. As we've posted on X now a couple of times, the next big bull trade for Amazon is probably through the overhead gap, point A up to point B. That's over 207.35, closes into 210.85. Let's move along to GOOGL, another one that does not really look all that great. If we're talking about market leadership from tech, why is this inverted head and shoulders neckline not really holding up for support here at 169? Obviously, you've got a lot of different things going on with Google, mainly the antitrust around Chrome, and we're going to put in a TB bid. We're going to put a bid out for Chrome, so if you want to chip in, feel free to contact the lawyers and we'll put together a deal. But for now, weak consolidation under 169 sort of would just look like a failed breakout, lower high underneath. It's just a little bit more bearish than bullish. So it's got to recapture 169 if I'm even interested in possible upswings. If you look at the hourly chart, nasty candle on Thursday morning. I mean, little counter trend move, but in the grand scheme of things, not nearly enough to be constructive back on the long side. Friday, really, really tepid action here as well, just like what we were talking about in Apple near its potential breakout point 229.50. So moving along to Metaverse, this one also pretty sloppy. I mean, let's go to the daily chart here just for the sake of clarity. You've got this huge daily balance range, right? Starting to break down here. And just no follow through whatsoever. So I wouldn't be comfortable calling this, huge overhead supply yet. For that to take place, I'd probably want to see it underneath the prior all-time high in the breakout point here at 542.50. But it's also not so clear that it's a look below and fail. We had a number of opportunities on the hourly chart, namely the Thursday gap up for gap fill reversal, rally back up into the range. You could have even supported over 561, noting that the high of Wednesday was here, 561 was here. No love at either of those levels, even on the Friday session, opening back over 561 over that afternoon consolidation low from Thursday. No love there. So I'm a little hard pressed to say that there's an obvious idea here in Meta. I don't think that the sellers completely have the upper hand. Otherwise, they should have capitalized on Thursday's momentum. But it's also not bullish, as we've clearly just walked through. So I think this is one step at a time, looking for some clarity out of this balance range down here. It's not cleanly trending. It's, the trend here is not up or down. It might start to flip down if this can persist as a lower high, but I would not. My concern basically is that I don't want to be short into this big weekly retest area, right? So a little in between on Meta. Let's move along to Tesla, which is absolutely cleaner. Got a 4-day balance range breakout on Friday. Really, really tough to capture that breakout unless you literally bought the break of the level. And FYI, it's called a Brigade Bolt, not a breakout Brigade, because you probably get better odds. You could go back and back test it, right? That's the whole point of the strategy. But Brigade Bolt probably offers you better risk reward and more successful trades than just being a breakout Brigade. So that's why we go with the Brigade Bolt. But intraday, let me show you on a 5-minute chart here. 5-minute chart, boom, right through the level. Maybe you could have played this as like a 5-minute 3-bar play, right here, here, and here into the level, but that might be risk reward along the lines of 2-to-1 maybe. I don't know. Maybe I'm just reminiscing about a missed trade, and that's fine. Just like this one was a classic. I forget who came up with it originally. Maybe it was Rake over at Rake Trades there, but like Pokemon, you can't catch them all, right? Back on the hourly chart, and shout out to Vince because he's still long this through the weekend, so prayers to Vince. Hopefully wakes up feeling good on a Brigade Bolt here. But I'm very interested in basically price action staying over 347. If we can get something that looks like this, awesome. Looking back up towards these equal highs, looking for continuation. If it goes for continuation, you got to show me this Brigade Bolt with an executable 5-minute setup, please, Tesla, at 358.50. So we'll see if that can take place. If it wants to conform to the rules of the strategy, awesome. I think the chart is absolutely bullish. On the daily chart, you've got sort of a bull flag breaking out from this perspective. Looks good. Tesla's probably on the long side. For it to be bearish, I would want to see this turn into a double top. You've got a ways to go until that triggers. That's under the neckline, potentially at 312. JP Morgan, smooth sailing here, starting to break out of its balance range on the Friday session over the all-time high, poking into blue sky territories. Looks good. All of these inside bars, because remember, this is the earnings gap up, all of these inside bars basically offered an opportunity for the sellers to persist and do something interesting. Looks to me more like accumulation in here. This aligns with what we've been talking about from a fundamental perspective, mergers and acquisitions, investment banking, private equity, all these different arms of the company, if you will. And don't hold me to it. I'm not overly familiar with JP Morgan's business, but you get the idea. The financial space doing well, the XLF breaking out as a sector. JP Morgan's the second heaviest weighted component of the XLF. It looks like it could see continuation into blue sky territory. So it looks good here over 248. Ideally, if it does pull back into range, it's just a higher low to persist over this trend line, and we get continuation over time. If it falls deeper than 244.75, I would just be neutral back inside of this range. I wouldn't really call this a successful breakout yet. Yet. Technically, it's closed over the level, but I wouldn't call it a breakout just yet. It's just the beginning stages of getting in gear. Let's finish up the core list of companies with Netflix, the mind of its own trade. This is something that we've talked about so many different times here. All of these different earnings gap and goes, basically, and this one is no different. I honestly thought there was going to be a little bit more consolidation after Friday's bar of last week, but right back on the horse, right back in the upward direction, and trucking along here. So pretty difficult if you're not already long Netflix to be involved at the tippity top of the move. I don't think it's a short. I would not step in front of the moving freight train, as we've been saying around the channel for a number of years now. Do not tug on Superman's cape. Let me know the song down below in the comment section if you've got it. And with that, we've completed the core list of companies. The single trade idea I have for you, and if AMD was setting up, I'd bring that up, but it's just simply not. It's not really doing anything interesting. But the trade idea I have for you is Visa. Visa is consolidating in this range. Visa and MasterCard both have a huge monopoly on the businesses that they run, basically credit card processing. Again, another topic from conversations over at Walks in Wall Street, Tom's channel. If you're not hanging out there after hours, when the market's closed, I would recommend you come for the laid back conversation about financial markets, exploring New York City and sometimes Miami. But Visa, nice little possible breakout area here over 312 into blue sky territories. Makes sense from a fundamental perspective. Maybe not, we don't know about the valuation here. Is it worth it? But the business model makes sense. We know that. It's been in a strong uptrend for a very long time. You could look at, monthly charts, strong uptrends here, breaking out. Generally speaking, trying to look for long opportunities in V. The price point is right. The options move okay here. Please just be mindful of the spready nature of something that's a little bit lower liquidity. You could take a look and just see that we've got, about a 40-cent spread here on the at-the-money call expiring this upcoming Friday, 310 there. So just be mindful of that. Make sure you're picking something with enough liquidity. Sometimes the monthlies are a little bit better in terms of liquidity, a little bit less of a spread happening here, about 25 cents, and some more open interest. I would really scan for volume, though, if that's what you're interested in, how much turnover is happening intraday. So that's what I'm watching here as an additional trade idea to the core list of companies that we've been through so far. Stay tuned over on our X feed. It's where we've been posting a lot of ideas and just consistent commentary on the market. If you're interested in that type of thing, give us a follow over there. If you've enjoyed today's episode of the Weekly Watch List, or if you've learned something new even, let me know down below in the comments section. We've been doing better with sort of banning some of the bots, cleaning up the comment section, getting active down there, and having the conversation continue. So let me know down below, or just give the video a very simple thumbs up. We will be live up in the penthouse on Monday morning for our pre-market prep, kicking off at the 8 o'clock Eastern time frame. We are flying on Tuesday out to Barcelona. So I'm not sure what the remainder of the weekly schedule will look like, but I will update you on Monday when I have a clearer picture. With that said, have a green trading week, and I will see you in the next one.